A very good morning, good afternoon, and good evening to all. Myself, Vaibhav. In today's session of automated trading, we will be starting a fresh new setup involving linear regression intercept and Williams R. Till yesterday, we finished off our initial setup with the use of linear regression intercept. Now we are using more complex setup here, and for that we are bringing in the Williams R and ATR as well for optimizing purpose for entry and exit. Here there is a brief description for the linear regression intercept indicator. And the Williams R, we have worked with the Williams R, I think, more than a month back. And this time around, we are not actually using it for overbought oversold situation. We are not taking contra trade. Rather than that, whenever it will be entering the overbought oversold scenarios, we will be actually try to use it in that particular direction and not against it. So we will see how we can do that. And the ATR for entry and exit, as I said. Before we get started, here is a standard disclaimer. Here I would like to remind that this session is simply for the tutorial purpose and no claim is being made regarding the profitability or otherwise of the algorithms which we will be developing during the session. Suppose if you want to use any of it, I would recommend that you do extensive testing before using it on live account, and if needed you can also let it run on the demo account to get a good idea of its working. And of course, nothing in the webinar is to be constructed as an advice to trade or for any particular setup. On that note, we get started for the day. First, we will see on the chart what we are trying to achieve in today's setup. So here, this is the chart for the Euro USD on the hourly time frame, and our setup is going to be built on the hourly time frame. Suppose if you want to change the time frame, you can change it. You can make it like 4 hourly or half hourly or 15 minutes. It doesn't take too much of an effort. You simply have to change the time period variable in our algorithm setup, so it's fairly easy to do. Now here I would like to explain how we are going to do this, and we are utilizing the linear regression intercept as a marker for our trend side. If the price action, if the last hour's candle close is above the linear regression intercept, then we will be looking for the buy trade, and if the last hourly candle close is below the linear regression intercept, then we will be looking for a sell trade. So basically our idea is to use this linear regression intercept line as a deciding factor whether to go long or whether to go short. And then we come to the Williams R, and on the Williams R we actually want the buy trade to happen when the momentum is strong, when the Williams R value is in overbought scenario, then it should go for a buy trade. When the Williams R values are in oversold scenario, it should go in for a sell trade. But there will be some restrictions here, and it won't be the case that every time the value is showing in overbought scenario. Not every time our trading setup will initiate the trade. So here what we will do, we will factor in the change of trend from the linear regression intercept. So suppose let us take the example of the buy side. So now as you can see here, the time is 3 GMT of 15 June, and here as you can see the last hourly candle close has happened above linear regression intercept, and we will make sure that just say 2 hours back the price action was in bearish territory, that is below the linear regression intercept. So we will utilize the shift 1 and then shift 3 to check on the prior candles as well, and we want the trading to happen only when the trend change is in the initial stages, when the trend is changing from being in the bearish territory to bullish territory with strong momentum, as can be confirmed by the fact that Williams R is also entering into a overbought scenario. Only during such times the new trade should be initiated, and for that we are bringing in this condition that the price action should have been below the linear regression intercept. And for the sell trade, inverse will be true. Suppose now if the linear regression intercept is giving way for the price action on the downside, then we will need the prior price action to have been on the upper side of the linear regression intercept, and so for that we will check on the hourly candle utilizing the shift 3 variable. The lookback period will be 3, and there we will see that the prior price was in the buy territory, and now it is freshly entering into a sell side setup. So in given circumstances, we will also need the Williams R to have entered into a oversold scenario indicating the strong momentum, and it will be initial hours only. So we will look on that as well to make sure that Williams R is just now entering this bearish territory, oversold territory, and the value is below minus 80. And in such scenario, we will be going in for a sell trade. And the additional condition we will be imposing is that the trade should be initiated only during the first hour of Williams R entering into a oversold or for matter overbought scenario. So we will want the prior candle to have closed above minus 80, and then the last candle close should happen below minus 80, and for a buy trade the prior candle should have closed below minus 20, and then the last candle close should happen above minus 20, and only during that time, only after that hour, the trading conditions will be in place, and then we will initiate the trade utilizing the ATR values. We will look on the hourly ATR, what kind of ATR situation is there, the volatility, and we won't really be going in for a market open. This time around, what we do is whenever we see that the price action is giving strong indication that it is just initiating the direction change with strong momentum, then what we want is we want the order to be placed say hourly ATR range below the last hour's candle close. So we will be betting on some correction in next 2-3 hours, and if that happens, then our trade will get initiated, and additional hourly ATR range can be utilized as the stop loss. And so what we will do, we will deduct the ATR value from the last hour candle close. That will be our entry point, and then we, for stop loss, we will be again keeping the order the equivalent of hourly range. So we will be going in for a pending open, and for the sell side trade we will initiate the sell trade whenever the Williams R enters into a oversold scenario, and these are just initial hours, and then we will add the hourly ATR range to the last hour candle close, and then on the top of that again 100% of the ATR range will be our stop loss. And on the target price side, I think the twice of ATR range can be utilized as our target. So you can say that risk reward ratio would also be equal to 1:2. So that is the setup which we are trying to work with in today's session. I hope you have got a fair bit of idea of what we are trying to do, and if not, you can always write it in the comment section, and I would try to explain to you if there is some confusion on that front. So here for the day we get started on the Visual J Forex platform developed by Dukascopy Bank SA. So here we are. First thing we will need to do is do the instrument subscription, and for that we will utilize this start point on candle, and this will do as we are going to keep the order validity for almost 2 to 3 hours. I think 3 hours should be good enough, so we will do 3 hours this time around, and then First thing first, we need to bring in the default instrument block, and this time around again we will be working with the Euro USD. You can change it, simply you have to change this variable from here. If you want to use any other variable instrument, you can do that. And then we have to make sure that last ask candle, bit candle, any will do. You just have to match the candle instrument here. So here is the candle instrument, and the default instrument and the candle instrument should be the same, and that candle instrument should be Euro USD. So again we take last bit candle instrument and we write here, we change this to Euro USD. So here we will need to bring in where is the Euro USD? Oh. I think we overlooked it. I overlooked it. It sometimes gets frustrating. Okay, we got this. So here comes our instrument subscription. It's done. Now is the time to go for position info, and we want all position amount to be equals to 0. So here we do that, and now all position amount has been defined at 0. Next thing we have to do is to bring in the indicator blocks. In today's session we will try to assemble all the indicator blocks which are needed for our algorithm to work properly. So first thing we will need is the linear regression intercept, and it is mathematical indicator. So what we do is we take in the linear regression intercept, and it should be equals to 0, and we want it to be defined on the hourly time frame. So we do that. Shift is 0, time period is 14. We need to change the shift, and we will need 1 to compare it to the last hourly candle close, and 1 more we will need with a look back period of 3 to do the comparison for the hourly candle which has closed 3 hours back, as we are going to use historical data as well to look for the price action. So again we change this on the hour, we make it hourly, and it will be shift 3, time period is 14, line 20. Okay, so that's for the linear regression, and now we need info. So we take historical candles, get historical candles here, and we do have to change this to hourly. Shift 1, and we connect it. One more will be needed, so we bring it in. And here as well we change it to hourly. Bit side shift will be 3. Okay, now what we have to do is we have to bring in the Williams R and then the ATR. So where we will find the Williams R? Williams R is developed by Bill Williams. So here we get it, Williams R. And here also we will need multiple blocks for the Williams R. Williams percentage R, the time frame is going to be of 1 hour. Shift will be 1. Output value, one more is needed. So here we take this and this is again need to be converted to hourly time frame, and shift will be 2. And now we have to look for ATR. Okay, we got the ATR. So here we have brought in the linear regression intercept, the historical candle data, and Williams R, and now the final piece in our puzzle, the ATR. So with that we are almost done with the indicator blocks. Here we need to define this on the hourly time frame, and it will be shift 1, look back period will be of 1. So here we take this, and now okay, so here it looks good, and now we can turn our attention to some of the calculation which needs to be done. And for that we have to look on the mathematical side of calculation expression. We will define the entry point and the exit point, and also the execution points. And I think before we do the calculation for the ATR range, we will also need to take 2 more historical candle data blocks of 1 minute each. So let us get those as well to initialize, to pinpoint the precise location where the order execution will happen. We need this. So we disconnect it for a while, we put it somewhere here, we'll join it, but first we get this 2, and this will be defined on the hourly, sorry, 1 minute time frame, and the output is candle 28, candle 27. So now we define this with shift 1, candle 27, and default period will be of 1 minute. And this one as well, 1 minute, and this shift 2, now is the time to do the calculation involving the ATR. So we have to take the ATR, and for buy entry or for sell entry we will need to add or subtract. For buy entry, as I had explained, we will be subtracting. So let us assume that conditions are going to be fulfilled somewhere around 8 GMT or 15 June. Let us assume, we are not really sure. And then what will happen is we will need to deduct the 100% of the ATR range. So whatever is the ATR, we will be deducting those pips, and the ATR is at that point in time around 20 pips. So we will deduct 20 pips from 1.1267, and then the order will be placed, which will be valid for next 3 hours. And as and when the price will touch that point, our trade will get executed, and then it will remain in system. And this time around we are really going to get fortunate, but that's not going to be the case every time. So let us now assume for a sale trade, let us assume here the conditions are going to be fulfilled on 14 GMT, and 14 GMT is here, and at that point we will be adding the 100% of the ATR, and at that point in time ATR is 24 pips, so we will add 24 pips. And as I see, the price doesn't really go to that extent, so no trade will be initiated. So that's about it. So I hope you got the point. So we have to do that calculation now. So we first have to take the last hour's candle close for our, and that is last hour's candle is candle 21. So we take candle 21's closing level, and here it is, candle 21's close. And for buy side we will need to do the subtraction. For the sale side we will need to do the addition, and here is our ATR line 25 is the ATR. So we take this, and A1 minus A2 is going to be by entry. So here it comes. Okay, and for the sale side we will have to do the addition. So